Good morning, everybody. Hope you're having a good summer and catch on a good day. So now is a good time to tell us if things are going well, poorly. We can all benefit from either things going well or things going poorly, because we can always take lessons from both. So as I'm waiting to see if we have any of those, we'll go ahead and get started. So just like our events, we'll do a little riddle here. So I'm going to ask you guys a riddle. So Ellen is a quiet, intelligent, and loves the outdoors. And while a student at college, she majored in English literature and environmental studies. So I want you all to give me this answer. So we've got Ellen is a quiet, intelligent, and loves outdoors. While a student at college, she majored in English literature and environmental studies. So my question for you is this. Given this information, which of the following is most probable? That Ellen is a librarian, A. That Ellen is a librarian and a member of Sierra Club, B. Or Ellen is a bank teller. So which one of those is right? So let's see some answers. Getting quite a few, we're getting everything. We're getting A, B, C, A, B, C, A, B, C. Okay, we're mostly getting B's, which is what you would think. So I got two C's. So the two C's, I'm not going to, because we're going to find out that C is the right answer, and I'm going to go through that here in a second. But let me see why the two people that gave me C's, why you gave me C's. So you guys that gave me C's, tell me why you think C is the right answer. And guys, we'll explain why C is the right answer here in a bit. Aha, so Colin got it. Statistically speaking, there are way more lady bank tellers in the U.S. than there are librarians. That's the exact, yep, and so did Matt Chansey. There are more bank tellers than other things. So let's go through that. See, this is an example. This is why it's impossible to beat the market, because most people, just like myself, chose B. I chose B. So most people choose B, and this is why it's impossible to beat the market. In order to beat the market, people have to act in a rational and predictable manner. So why would, in order to beat the market, why would people have to react in a rational and predictable manner, guys? Why, in order to beat the market, would people have to react in a rational and predictable manner? Nobody's getting it here. Well, I agree with Kevin O'Neill, laws of probability. That's right. So, Kevin, I would agree with you. Laws of probability. Here's the thing. If things act erratically, is there any way to predict what's going to happen? If things are erratic, because the market is random and unpredictable short term. Right, Dan? So Daniel Goodwin said, the markets are random and unpredictable in the short term. So when people act in irrational manners, it's impossible to beat the market, because you don't know what people are going to do. For example, what caused, let's see if you can get the answer to this. What caused the 2007, 2008 stock market crash? What caused that? I'm getting people saying real estate bubble, but here's the thing. That real estate bubble was going on for how long, guys? How long was that going on? For years. Years and years and years. So what caused it to crash then? See, we don't know really what caused it to crash. If you go back to the 2000 crash, we could say it was the tech bubble, but what caused it to crash? Because the tech bubble had been going on for a decade. We go back to the 1987 stock market crash. What caused that crash? See, we don't even know. Even looking back on it, we know the general cause, which was in 2007, 2008, was the real estate bubble. In 2000, it was the tech bubble. In 87, it was. So we know what the thing that led up to it. But here's the thing: if we really knew that's what caused the crash, then we all would have what? If we really knew that that's what caused the crash, we all would have what? Because those things had been going on for years. So if we really knew those things caused the crash, what should we have done? Yeah, sold short, Bruce, exactly. We all should be right now billionaires because we should have mortgaged our house and what? Sold short and made millions and millions of dollars. See those, but because those things are going on, but while those things were going on, what do we keep telling ourselves? What do we tell ourselves in the tech bubble? And when I say ourselves, I mean the general population. What did the general population, including money managers, what did they tell themselves? This time is what? Yeah, just stay the course, Frank. Things are going to keep going up. This time it's different. It'll never burst. And then when it bursts, we're like, aha, yeah, it was the tech bubble. Like we knew that was happening all the time. The thing is, we never know why the market does what it does until what? We never know why the market does what it does until what? It does it. That's right, Barry, until it does it. And then we look back and we're geniuses, right? We look back and we're geniuses. Yeah, I know what to. No. Look, being a Monday morning quarterback is pretty damn easy, isn't it? But if we were really that smart, including money managers, what would they have done? And here's the thing. Were there some money managers that made money in 2000, 2008? Yeah, there's a couple of guys. A couple of guys made $1 billion in 2007, 2008 because they bet the market was going to go down. Yeah, Paulson. But did he make that money in 2000 when the market went down? No. So here's the thing. You can be there's been people that have predicted downturns, right? Has there ever been anybody who's predicted 2 downturns? Yeah, somebody won the lottery too, Barry, I agree. Here's the thing. I mean, there's been a lot of money managers that have made their names by predicting that the market was going to go down. But have they ever predicted it twice in a row? No. No. And I remember this. There's a guy. Who's that guy? He used to send out tons of direct mail, and he was predicting the market was going to go down from 1992 all the way to 2000. The market's going to go down. The market's going to go down. For 8 years, he said the market's going to go down. And then when the market went down and crashed in 2000 through 2002, my buddy called me up and said, "Oh, Mike, you got to follow this guy. He predicted the market was going to go down." And I said, "Well, Paul, he's been predicting that for 8 years, so I guess he was finally right." Have you heard of these? Some of these guys that sell penny stocks. Have you heard how they sell penny stocks? They'll actually predict the stock is going to. They'll call up people. 50% of the people they say the stock is going to crash, and 50% of the people they say the stock is going to go take off like a rocket. And why do they do that? That's right, Colin. If you're consistently on one side of the argument, eventually you're going to be right. So here's the thing. We have to agree the market is irrational because people are irrational. And I just want to talk about this one thing that this question demonstrates. So when it comes to the market, especially when it comes to the market, we're vulnerable to biases. And here's why we're vulnerable to biases. Anytime they found that we have lots of different biases because our brain takes shortcuts. But when our information is limited and we're required to act under time constraints, which is exactly what we do when we're investing, then those biases really get exacerbated. So people aren't rational. We're not thinking machines. We're feeling machines that happen to think. So our brain takes lots of shortcuts, and we've talked about this at our event. The brain takes shortcuts, and it does that because otherwise our brains would explode. If we did not take shortcuts, if we actually rationalized and thought out every decision we make, should I get out of bed this morning or not? Should I scratch my nose or not? Should I brush my teeth before I eat or shouldn't I brush my teeth? If we analyzed every single thing that we did, our brains would explode or we would be just completely paralyzed. So the way that we get through life is taking lots of shortcuts. And that works most times, but sometimes it can really bite us in the behind. So cognitive shortcuts can be good and bad. It turns out we don't make decisions according to internalized calculations, trade-offs, optimizations, and analysis, but instead we make irrational decisions most times. So when we talk about Ellen is a quiet, intelligent, and loves the outdoors, while a student at college who majored in English, literature, and environmental studies, given this information, which is the following is the most probable? Is she a librarian a member of Sierra Club, or Ellen, is she a banker? So let's look at this. What do most people choose? By far and away, over 80% of people, including myself, chose B. And that's what, when I asked you guys, we had a couple of C's and we had mostly B's, which is typical. And again, I was just as, I took that shortcut as well. And there's a couple of things going on here. One is conjunctive fallacy. So conjunctive fallacy is that people judge the probability of two events occurring in conjunction, being a librarian and in the Sierra Club, to be higher than either event occurring on its own. So of all the librarians in the U.S., how many do you think are members to the Sierra Club? The number cannot be greater than the number of librarians, right? So it is mathematically impossible for the joint probability to be greater than the single probability. So let me ask you a question. How does this fallacy affect investors? The fact that people judge the probability of two events occurring in conjunction to be higher than the event occurring on its own. How does that affect investors? Why would this be a problem for investors? Yeah, I'd agree with can't apply logic to the market performance. Yeah, you're all right. You're all right saying it's. Let's see. Some of it helps. Some is helpful, some is not, and it's harder to disseminate. I'd agree. I mean, you're all coming with great answers. If you think about it, though, and this is, how many of you have friends who are in investment clubs? Any of you guys have friends that are in investment clubs that are not in the business? And there's a ton of them here in Rochester. There's a ton of doctors who think they're what? There's a ton of doctors who are in investment clubs, and guess what they think? Yeah, they're awesome investors. And I listen to them at parties and things, and guess what they always do? I mean, and we're all, and I shouldn't just say them, I'm as guilty of it as anybody is. What you do is you find what? They find a product that they like, and then what do they go back and do? So they like Apple, so they like the idea of Tesla, or they go to a restaurant and they think the restaurant is really good, or they what do? They find that product they like, and then they go back and what? They'll go back and find events that back the fact that that's a good investment. So they find a product they like, and then they go searching for information that what? They find a product they like, and then they go back and search for information that what? Validates why they should buy that stock. So conjunctive reality is one of the things that is wrong here. The conclusion that Ellen is most likely a librarian and a member of Sierra Club seems most likely, but it is undeniably not more probable. So people will jump to conclusions, and that leads most investors astray. Again, here's the problem. What if you're a smart guy? How does that help you? If everybody around you is irrational, if you're in the middle of a burning theater and you're the only one that's rational, is that going to help you? No. Right, Kevin. Why not, Kevin? If you're in the middle of a burning theater and there's 300 people around you and they're irrational and you're the only herd mentality, yeah, but the fact is, what if you don't fall to the herd? Yeah, the chaos around you will prevent you from finding that door. You're caught up in the masses. You can't do anything. You're going to get trampled, man. Exactly. So that's the problem with the market, is you can be the smartest guy in the world, but if you're surrounded by a bunch of raving maniacs, which is essentially what we are. Now, here's the thing. Here's the really dangerous thing. Do investors think they're raving maniacs? Do investors think that they're acting irrationally? And that's the scariest thing, because when you're surrounded by raving maniacs who are irrational as heck and they don't think they are, yeah, long-term capital management, Colin, is exactly right. That's the biggest lesson that people should, and Colin's bringing up long-term capital management. And that's a pet story of mine, And I'll ask guys who think they're frigging investment geniuses, explain to me what happened with long-term capital management, and they'll say, well, what do you mean long-term capital management? What is that? It's a company in the 90s. What happened with that? And they can't even tell me what happened with that. If you're investing people's monies and you don't know the story of long-term capital management, you are dangerous. And I'll tell you straight out, I've asked probably fewer than 10% of the advisors I talk to know that story, which means 90% of the people out there that are managing people's monies shouldn't be. It's crazy. So it's empirically more probable that Ellen is just a librarian rather than a librarian and a member of Sierra Club. That's conjunctive fallacy, that she's just a librarian rather than a librarian and a member of Sierra's Club. But we tend to want to connect two things together. Librarian is not the answer, though, as Colin and Matt and somebody else, I think Kevin, predicted. Librarian is not the right answer. It's a better answer than librarian and Sierra Club, but it is not the best answer. If we use probability analysis, which is what these guys did, how do we calculate probability? Well, here's the thing. First of all, we find out how many librarians and bank tellers there are in the U.S., which is what Colin was saying. You compare those numbers to the general population. I mean, Matt and Kevin are also saying that as well. Compare those numbers to the general population, and the total of librarians and tellers are called the base rates. Yeah, and Frank's saying smarts can blind us to examine things deeper. Exactly right. Compare those numbers to the general population. The total of librarians and tellers are called the base rates. But we intend to ignore the base rates. See, according to the Bureau of Labor and Statistics, there are 145,000 librarians. There's 544,000 bank tellers. So statistically, Ellen is 3.7 times more likely to be a bank teller. So it's not even close. She's 3 times, so almost 4 times more likely to be a bank teller. But we jumped to a conclusion based on what? See, did we know anything about Ellen? Yeah, I guess we knew that she was quiet and that she was smart and that she liked the outdoors. So then we jumped to conclusions, right? Yeah, limited information, Kevin. But wait a second. Why would that be wrong? Why would that be wrong? Because if you think about it, librarians, aren't librarians quieter and smarter than bank tellers? So why wouldn't that be the case? Guys, the fact that she was quiet, smart, and liked the outdoors, what is that valid information? No, it's not valid information. According to the numbers, according to logic, it's not. But we're trained as human beings to what? Make inferences. To draw conclusions. But it's not valid information. Unless it's what? Compared to the facts. The facts, think about this. Smarter, more intelligent, are those what? What are those? Objective or subjective? They're subjective. And then we use those, and you know what? Is it easier or harder to crunch numbers? It's much easier to just jump to a conclusion. See, we didn't ask the question, are librarians quieter and smarter than bank tellers? That's not the question we asked. We asked, is Ellen a librarian? Is she a librarian and a member of Sierra Club? Or is she a bank teller? So we should be applying logic, math to that. And that's where we come up with that she's 3 times more likely to be a bank teller. And we call this representative bias. See, C feels like the logical, C is the logical answer, but it doesn't feel like the right answer. It's logical, but it doesn't feel like the right answer. If she's smart and she likes the outdoors and she's quiet and studious, the likelihood is she'd be a librarian. That's what I would think. And if she likes the outdoors, even better, she'd be a member of Sierra Club. It doesn't, it's based on our, yeah, exactly, Kevin. We can't make decisions based on our emotions, but you know what? We do it every single day. And let me give you an idea of that. When I hear a guy talking up his money manager, guess what I hear in his voice? When I hear an advisor talking up the money manager he uses, guess what I hear in his voice? I hear belief. I hear belief in his voice. What's the problem with that? Yeah, well, it's subjective. The problem is he's making a decision. He loves his money manager. And you got guys, you got to love what you sell. You have to love what you sell. You're not going to sell any of it. But the fact is that guy is emotional about his money manager. Has he checked every single money manager out there? Most guys, when I talk to them about their money manager, if they've done a real in-depth analysis checking out 100 different money managers to find the right one, or do they hear a story that they like and they what? They hear one story from one manager that they like, and then what do? And guys, you can use this because this is your competitors we're talking about. They haven't checked out all the money managers. They found the one manager that they liked, listened to his story, they loved his story, and now they're what? Out beating the drums for this guy's story. So how does this apply to investing? Well, representative bias is ever present in the investment world because we jump to conclusions with investments all the time. See, it's easy to confuse a good company with a good investment. Guys, just because it's a good company, does that mean it's a good investment? Just because it's a good company, does that mean it's a good investment? Heck no. A good investment is based on what? Crunching the numbers. And should you just be crunching the numbers of the company, guys? Can you just crunch the numbers of the company? No, you can't. Yeah, you have to crunch the numbers of the industry too, Dale. You have to crunch the numbers of the economy. You have to crunch numbers of the people who are buying the product. You have to crunch, and how many guys do that kind of crunching? And here's the real problem. Once you find a money manager who crunches the numbers and has some success with that, now what do they assume? So they crunch some numbers, and this has been really happening a lot in the last 5 years. There's been money managers that have done really well in the last 5 years. What would you say to that? Because they've done so well in the last 5 years, they're saying their numbers work. Of course they've done well. Everybody's done well. But they now think that what? They've got the formula. Or like the handful of people that got things right in 2007, 2008, they now think what? And remember here about 6 months ago when we went through all the hedge fund managers, how many of them are still standing? The top 5 hedge fund managers from 8 years ago, how many of them are still standing? 1 out of 8. So you can't confuse a good company with a good investment. But it's also easy to see you're ignoring unbiased analysis. Or you can't confuse a great product with a good company. And this is where I hear all the self-appointed investment gurus that I'm surrounded here in Rochester with all the doctors and people like that who have their who have these investment clubs. They, like I said, they eat at a great restaurant, and then what do they run out and do? They go and find the numbers that back that restaurant as good investments. Their friend buys a Tesla, so then guess what they do? They go out and research it. Now, are they looking at it unbiased, or are they looking for the data that will support that it's a good investment? Are they looking at unbiased data, or are they looking for the data that supports their investment? They're looking for the data that supports their investment. And that's just human. That's not because they're bad people. Are they the only ones that do it, or do we all do that? I do it every day. I'm always looking for information that backs my point of view. That's human nature. That's why we have Fox News and CNBC, isn't it? See, this is a great example of that. Apple is a fantastic example of that. So you got this Apple guy, he's shaking his fist toward the non-Apple believers. He's got a clever Apple merchandise. He's got an empty wallet. He's got a messenger bag full of every portable Apple product in the market. The rest are at home. The massive list of reasons why consumers don't know that they want and should buy what Steve Jobs recommends, and their overall defensive demeanor. So so we start to say, hey, Apple's got to be great because it has great products, because it has great fans and proponents. So obviously Apple has to be a good investment. But Michael Keller of Investment View said, right now Apple's not the best investment out there because it's got major challenges to profit margins. It's got consumer fatigue. People used to go buy every time a new iPhone came out, they went and bought it. They threw their old one away and kept, and bought the new one. Now are they doing that? No, they're consumer fatigue with Apple products. They have future product launches. We don't know what's going to happen with future product launches. Steve Jobs is no longer driving the boat, and there's just a general rapid pace of technological progress. What does this mean, guys? General rapid pace of technological process. What do you think that means? Competition, yeah, I agree with that. Yeah, competition. And not just competition from other companies, but competition from what? Other what? Technology. What you buy today is irrelevant tomorrow. It's always changing, right, Kurt? So there's more and more products faster and faster and faster. Can you guys think of an example of this that's very similar to Apple? What's an example of this that's very similar to Apple? That ruled the world and died a very rapid death. They ruled the world, and 2 or 3 years later, they died a BlackBerry, right, Michael? BlackBerry. Remember when everybody had a Crackberry? I mean, they were making fun of it. They called it Crackberry because people had these BlackBerries, and everybody had them, and everybody was using them, and they couldn't turn them off. And then where's BlackBerry today? RIM is down 94% from what it was at its peak. See, it's another manifestation of representative bias. Investing here's another manifestation of. I'm sorry. This is another representative manifestation of representative bias. Investing based on past performance, which I love this little cartoon here. Pen drawing. Driving while looking in the rearview mirror causes lots of accidents. So what are some great examples? Well, and Colin brought up long-term capital management had 100 years of back testing, and within 3 years, guess what? 100 years of back testing, and then after 3 years, guess what happened to it? And it nearly took down the entire world's economy. The crash of long-term capital management in 1998 nearly took down the world's economy. But we believe that back testing validates the future. Guys, does back testing have anything to do with what's going to happen in the future? Anything whatsoever? I mean, the example I like to use is between the Civil War, so 1865 and 1970, interest rates never went above 5%, right? So when you looked a client in the face, what did you tell him? Obviously, interest rates can never go above 5% for 100 years. During wars, during good times and bad times, during lots of different presidents, interest rates can't go above 5%. And then, boom, what happened in the 70s? Up to 20%, 4 times, 400% higher than 5%. So past performance is no guarantee of future results. Really, though? Come on. That can't be right, can it? Past performance is no guarantee of future results. That can't be the case. I mean, look at all those mountain charts they have. Doesn't it seem like what went up yesterday goes up tomorrow? I mean, that's what those mountain charts are about, right? So I would think past performance does guarantee future results. That's what all those mountain charts are showing you, that the market always goes what? The investment always goes what? Up. I mean, it sure seems that way, doesn't it? So again, intuition once again ignores what? Logic. And instead, what it does is it starts to ignore things. So it starts to say, hey, a high PE is worth it. This is what happened in the 2000s, right? I know PEs are at 35. But guess what? We'll grow into them. The companies will grow into them. So let's ignore it. This time it's what? Different. That was, the tech. I know this company is not making any profits. But it's what? Look at its stock. Obviously, you wouldn't have mutual fund managers and venture capitalists buying this stock if it wasn't eventually going to what? Make money. So it has nothing to do with whether it's making money now. The stock would not be going up unless it was a good investment, right? Guys, do we learn from those mistakes, or are we doing those same mistakes again? Are we making those same mistakes again? This time it's different. I love that one. This time it's different. Oh, no, you don't understand. I know they're not making money. I know blah, blah, blah. You got see, guys, when we start investing, when we find a stock or a product or a company we like, we start to explain to people why the numbers don't make sense. See, and we start to say, you're looking at the numbers wrong. No, the numbers are numbers. You can't look at numbers wrong. See, this thing is on a roll. You can't lose. Look at its history. Over and over and over, we look at we make these same exact mistakes. This time it's different. I know the numbers don't make sense. I mean, think about this, guys. 2007, 2008, very, very, very smart people. Very, very, very smart people were doing stupid things based on what? Hey, this thing is working now. I know that we're buying these junk mortgages. I know we're rolling them into crap products and stuff. I know these things aren't working, but you know what? Or make no sense. But they're what? They're making money. So if they're making money, they got to be what? I don't care how bad they look. If they're making money, they got to be good. And guys, very, very, very smart people were making this mistake. Guys that make a living doing this, guys that can crunch numbers that we couldn't even blink an eye at, were making this mistake. Why? Because they're human. Just because you're on Wall Street doesn't mean you're human. Just because you're a hedge fund manager doesn't mean you're human. Remember, we said 6 out of the 7 biggest hedge fund managers are out of business. George Soros was claimed to be one of the best investors of all time, and what happened? Folded. Guys, it's just something we have to live with. That's why we do what we do, right? That's why we do what we do. We help our clients protect their money because you can't predict the future. Now, I think Daniel Goodwin said earlier, short term, the market is very unpredictable. Long term, it is predictable, right? Short term, the market is unpredictable. And short term is what? 3, 4, 5, 6 years, up to 10 years. That's short term. But long term, it is predictable. Because if we didn't believe the economy was going to grow, if we didn't believe the world was going to grow, I mean, we'd be buying beans and ammunition, wouldn't we? If we really thought the world was going to go to heck in a handbasket, we'd be buying beans and ammunition. So we do need to invest in the market, but we need to invest in the market with what kind of mentality? Long term. And what does long term mean? Because long term, the market is predictable. Over time, the market will go up. But when we're talking about over time, what kind of time components are we talking about here? 1 month, 1 year, 5 years, 10 years. I'll tell you what I look at long term. And what did we find out with the 10 years from 2000 to 2010? Did the market go up? From 2000 to 2010, did the market go up? That's 10 years. Did the market go up? Yeah, it did, and then it went, what? Down, and then up, and then down, and then up and down. But in the end, it made no money for 10 years. So I agree with Dan Goodwin. Over a long term, it is predictable. But over short term, it is not. And guys, I'm 52 years old now. And when I look at myself, the difference between 52 and 62 is how big, guys. You know, between 22 and 32, I didn't think that was big a deal. 32 to 42, I didn't think that was a big deal. 42 to 52, I didn't think that was a big deal. But I guarantee, what do I feel from 52 to 62? Is that a big deal? It's a huge deal. 62 to 72, now what huge deal became a what? Immense deal. And who do we deal with? We deal with people who are retired and waiting 10 years, telling me to wait until I'm 62. Guys, will I be able to do things physically that I can at 62 that I can right now? How about 62 to 72? Will I be able to do things physically at 72 that I can right now? What can happen between 52 and 62? A lot. Could I have health problems? Could my family have health problems? Could I die, Bill? Exactly. So having your clients wait for the market to recover is absolutely 100% what? Asinine. So having our clients in growth for the long-term growth so that they still can buy things 10 years from now, 15 years from now, 20 years from now makes absolute 100% sense. But having half of the client's monies sitting in something that's guaranteed, and the thing that's going to give you the highest rate of return that's guaranteed is a fixed index annuity. The thing that's going to give you the highest rate of return in a guaranteed basis is the fixed index annuity. So having half your money in a guaranteed thing and having half your money, and I'm not saying 50-50, but I'm saying having a big chunk of your money in guaranteed and a big chunk of your money in growth makes sense, because that growth is unpredictable short term, because we are irrational creatures, not you and I, everybody. The investor next door and the guy on Wall Street, the guy that doesn't know anything about stocks, and the hedge fund manager. We're all human beings, and we have no clue what's going to happen. So we need to make sure that we have a big chunk of money. Why do we want a bunch of money in safety, guys? I'll tell you why. So that people don't do stupid things when the market falls. If you have all your money in the market, and too many clients, it's still unbelievable, because Jeff crunches the numbers for these case analysis you're doing. Guys, I still see people who are 60 and 70 years old that have 85% of their money in the market. It's crazy, and it's our job to make sure what? Because what's that person with 85% of their money in the market going to do next time the market crashes? What's that person with 85% of their money in the market when they're 60 years old, 65 years old, 70 years old? They're going to what? They're going to get out. They're going to withdraw. Guys, this has been proven over and over and over. People pull money out of the market in record amounts when the market crashes. And then they shove it over into bonds, right? Because they see bonds are going up, so then they shove it into bonds. And then they ride bonds down, and then the market goes up 30%, and then they get back to the market. They do stupid things over and over and over. And even if you're the only sane person in the room, doesn't matter. If you're the only rational person in a burning theater, you're going to get crushed. So that's why we do what we do. We do want growth, but when we look at growth, we're talking 10 years plus. And we need to give our clients that cushion so that if those things happen in the next, where things get hurt for 10 years, our clients are going to still be okay. So last week I was saying that you guys are heroes because you're taking care of all those non-financial things. And this week I'm saying you guys are heroes because you're out there making sure people are doing the right thing, because we don't know what's going to happen in the future, and there's nobody out there that does. Does that make sense to everybody? So there's lots of fallacies. I'm just showing you two of them. But we have to be helping our clients. The only thing we know about the market is that it's unpredictable in the future. It's hilarious, again, when I asked earlier what caused the 2007-2008 crash, what caused the 2000 crash, what caused the 1987 crash, we all were saying, oh, yeah, it was this and this and this. Guys, if we really knew that, none of us would have been in the market. We would all have been unbelievably wealthy because we would have bet against the market and made all sorts of money. So the fact that we only know what causes the market to go down when, the only time we know what causes the market to go down is when. The only time somebody can tell me, have a reason for when the market is after it crashes. Since that's the case, it's the only time we know why the market goes down is afterwards. That tells us that by the time this happens again, we won't know that's going to happen. We can say why it happened afterwards, but we're going to know why it's happening when it's happening. Because when the market falls 10-20%, what does Wall Street say and all the news sources say when the market falls 10-20%? It's a healthy what? Well, that's a healthy correction. That's a healthy correction, and we really need this in order for the market to do what? I mean, this is a very healthy correction because we really needed this. I mean, the fact that the market's going down 10 or 20% is what's going to allow the market to go back up. Guys, that's a crazy person talking. That's like saying, yep, that person that got cancer, they needed that cancer because why? It was the only way for them to get healthy. How idiotic is that? So my point here is we're doing the right thing. We've got our clients in growth for that 10-year, 10-year plus horizon, and we've got in safety to make sure they get to that 10-year horizon. Okay? So for more on these biases, you can go to the article "Why Bad Decisions Happen to Good People" by G. Scott Clemens, who's a certified or chartered financial analyst, and great article. I've only tapped into about 10% of what this guy is writing about, and it just makes you shake your head. You see it over and over and over in everyday life in what we do. So hopefully you guys don't mind this kind of stuff every once, the more theory type stuff every once in a while, do you? Is that okay to do theory every once in a while? Good. Super. Well, then that's all I've got. Any questions, comments that you guys want to talk about before I let you go? I see nothing. Awesome. Well, then you guys have a fantastic rest of the week, and we will talk to everybody on Friday. Thanks, guys.